Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And back today, guys, with another stock analysis, one that will be used in eToro references and content moving forwards, because it is a position in the portfolio and one that I'm looking to which I'm looking to continue adding. So we're going to talk about that today. The stock is Pacific Western Bank. Very interesting things happening in the US banking sector at the moment, and I'm hoping to enter in and take advantage of it. So disclaimer, guys, I'm not a financial advisor. None of this is to be construed as advice. It's just my opinion, my channel, my thoughts put out there to the world, what I'm doing and what I think. That's all it is. So you need to make sure that you take responsibility for your own decisions and seek that of seek the advice of a qualified professional. That I most certainly am not. My opinion, no advice, no recommendations. Okay, we've gone through that. Quick announcement: if you're watching this and you're not already subscribed, at least to the free link to the Options Mavericks, you definitely should be. And this is a way where if you like the analysis today and if you like the opportunity, what I do in a private Substack group is show you how I generate income by trading options. This is a way that I generate weekly to monthly income. And so far, the track record has been very, very good. How do I do that? I sell insurance options. I'll go through all that inside the group. Track record last year, we had an annualized track record of 25.85%, which is a great ROI. So far, we're having a cracking year, 88.17 annualized. Obviously, the year's ongoing, so that's subject to change. You should know none of it is just dry theory, selling you courses and things like that. No, none of that. It's me sharing exactly what I do and how I place the trades. You get an Excel sheet with every single trade documented into the group, and that performance is tracked over time, as you can see. In addition to that, I give my thoughts on certain assets over which I trade stocks, what I think they're worth. Again, a lot of my opinions, all on a very easy to see spreadsheet. You get the name of the stock or the ETF or the commodity or the whatever, and what I think the value is worth, and you get access to that real time as it updates. It's just, yeah, documenting my journey, having fun, different way to leverage capital, different ways to make digital income, and the details are in the link below. There's a free 7-day trial, so you can go in there, take all the best stuff, and then not pay if you wish. The typical Substack deal, guys, you should know by now. There's that much great stuff on Substack. So two things. You're wondering, Ben, why aren't you in full slide mode? And that is because for whatever reason I'm having issues on this my other laptop desktop setup, Zoom going into full motion. But anyway, we're zoomed in, so you should be able to see. And the next thing is, okay, we're talking about a recent crisis in US banks. It seems to have kind of all bubbled over now, and we're getting a much clearer picture of things. So super quick rundown. There were fears of bank runs following the demise of Silicon Valley Bank. Now, there's so much out there that you can read online, great analysis. I'm not going to rehash the story and give my own. I just think you can go on there and do some good reading. Check out Jim Rickards, Alfonso Pecatiello, Saad Khan, all these guys. They really give great analysis. So no need to reinvent the wheel there. But we had a bank. It had done basically no risk management, and in its fixed income, had carried these at hold to maturity. So they invested in and leveraged deposits in all sorts of different bonds and things like that. With the rising interest rates, the value of those fixed income instruments has obviously dropped quite a lot. Initially, you don't see that because it's held in an accounting part of the balance sheet called held to maturity. You legally do not have to update the face or par value of those instruments, because the plan is that you're going to hold it to maturity and not have to resell it. Problem: when you've got liquidity issues and your customers are drawing deposits out of the bank, you need to be able to have liquidity, cash, somehow to give to those depositors, right? So when you run out of cash, you got to start selling your assets. And these assets in the hold to maturity, all of a sudden, were not going to be held to maturity. They had to be put into the available for sale Okay, so to be sold onto the market. And when you do that, you have to be marked to the current market price. So if you had a bond with par value of 100 and it's now worth 80, you can imagine what that means when you have your assets marked at one valuation. Now you've got to try and sell them at a steep, maybe 20% valuation currently in the market from when you bought it, in order to make up the losses, or in order to satisfy the withdrawal of deposits. Okay. They didn't have as much coverage as they should have, and so that was obviously a problem. And we've had all sorts of things. The Fed stepped in. We had the buyout and that retransformation process of the bank appears to be basically settled. What people are worried about is if you have your deposit in the bank and then the bank goes under, anything over $250,000 in the US is not insured. And so anything over that amount, you can, under normal rules, you can say goodbye. Normal was a long, long time ago, and we're going to talk about that. But for the point of today, we've had a broad sector sell-off in all the banks because there's worried about contagion risk, and Pacific Western is one of those banks that people were worried about. They're saying, hey, wait a minute, maybe these guys have some liquidity issues. I tend to think that they've been unfairly sold off and that there could be some value there. So the point of today, Pacific West, is there opportunity in the rubble? We'll need to know a few things. Key, what's the health of its balance sheet currently? It's trading at a massive discount to book. So the idea would be to buy it at a massive discount to book value and wait until that reverts. In the meantime, will we get paid? Looking at their ability to pay out dividends and their previous history of dividends, I say yes. So that's very good. I'm happy with those two. The question will be the health of its balance sheet. And if I'm correct in the thesis, moving forwards, there should be handsome returns on offer. So worrying about the bank runs, how worried should one be in the US? Well, you've got up to 250 grand still federally insured. What we saw was basically unprecedented as far as I can piece together. Yes, we had massive bailouts in 2008, and that became politically unpopular. But it's also just as politically unpalatable to have depositors fail and lose their money in what normally will happen in a true free market capitalist system. Is okay, above the insured amount, bank goes under, debt for equity restructure. Okay, you lost your deposit, you're way down in the capital stack, bondholders get paid out, gets converted into equity, and then if there's anything left, perhaps above your 250 grand, you get some bank shares that may or may not be worth something. But what we have seen is a kind of a hybrid, like bail in and bail out. The Fed, at least, or the US Treasury, is saying, don't worry about your deposits because we're going to make sure no one loses their deposits, no matter what the deposit amount was. Super interestingly, the Fed buying these what were hold to maturity bonds back at par value. So this is a massive free kick to the banks as far as I can gather, because if you've gone out and leveraged and speculated all your depositors' capital in investments, and those investments have tanked. So let's say you invested $100 million, and then all of a sudden what you invested in, it's now worth 80 million. What's happening is the Fed has said that they are going to accept these bonds back, and they're going to give you 100 million for them, like what you originally paid as the bank. So buying them back at their original par value, it might sound good to prop up the banks and the Fed's going to paper over it, but that's going to lead to huge amounts of inflation, surely, entering into the system, and definitely some moral hazard to go along with that, because bankers, they're not often shy in taking risks in some of the capital, because they get access to the upside in their performance fees and bonuses, but they don't apparently lose their deposits like the rest of us. So yeah, I'm not sure how that's going to work out in the future, but in terms of investing in banks, it's almost like the government, at least it appears this way, the government is going to protect your investment, which, from an investor perspective, I guess is not the worst position in the world. Okay, so recently, let's take a look. At the top is the select financial sector in the US. So that's been sold off recently, fairly sharply for an entire sector, 12.84%. But if we look at Pacific West, a big California-based bank, people are worried about its exposure to Silicon Valley. It's down 74.6% since this recent sell-off. So they're going to be two main theses. One main valuation method, what's the book value? Okay, cash flowing banks, forget it. You're not going to be able to figure it out. It's too hard. But book value, provided you can look into where the assets are, what type of assets are, if you're happy with the collateral, if you're happy with the assets, that's usually, for me, the best way to look at a bank. So what has the market normally been willing to pay for Pacific West's book value? So the assets minus liability, the market says, yep, this is worth X amount. We're going to pay you 2x, 3x, 4x, whatever the case may be, as a multiple. Normally in big banks, you can pay sort of up to 3, seems to be pretty standard value. Pacific is a little bit of a smaller bank. If we look back, what I've done is taken the history as of 2009, because 2008 or before 2008 was before the GFC. So these stocks were trading like 5 book value. And I think that should be taken out of consideration. Here, if you're looking from 2009 onwards, generally speaking, the mean price to book, to tangible book, is about 2. Okay, as high as 3.6 and low is where it is currently. Okay, it's never been lower in terms of a book valuation than what the market's currently giving it. Okay, so if we were to look at that, we'd say, well, gee, there's almost a 4x in reversion to mean just on the multiple. So that is not unreasonable. It's not unreasonable to expect to pay twice the book value for a bank of this particular size. You're probably not going to get 3, but you should certainly be paying more than half the book value. The next question is, well, how certain are we that the book value is what's recorded and doesn't have all this sort of crap in held to maturity that's being valued at what it used to be and not what it is currently? And so in the case of Pacific West, that's about 8% of their loans. So we can adjust for that, and that should give us a good picture. So a super quick company overview. Revenue and EBIT, they are important. They're not really what I'm looking at. I'm looking at the net asset value. So 2023, it's expected, analysts are expecting it to take a haircut in revenue and EBIT, which is operating income or net income for a bank, I should say. 1.15 billion in revenue and around about 357 million in, we'll call it net income. It's on a market cap of 1.12 billion. So it's trading about 1 times the revenue. So it's a smaller bank, and it's really trading quite cheaply. Shares on issue, 115 million shares on issue. They, looking back over the history, they haven't really issued a lot of shares. So they're not, as far as I can tell, they're not a dilution risk. They certainly haven't behaved that way thus far. And they've had some tiny buybacks along the way. So they've kind of reduced the share float. Okay, now that is not correct. It is currently trading at 971, and for whatever reason that hasn't updated. So I'm going to do that right now. Bear with me. And the tangible book value is correct. And what I've done here is I've adjusted for that 8% of their assets that were held to maturity. So what I've done is said, here's an aspect that might be exposed to some of this hold to maturity write-down risk, exposure to the Silicon Valley. Let's just assume it's all worth nothing, like 0. And so what I've done is taken 8% of the entire tangible book value and written it off. And that's where you come up with this $15.7 of tangible book value per share. Return on equity, around about 10%. It's okay. It's not the best, not the worst. But this is it. In a nutshell, just remember this if you're getting lost. We've got a back over the envelope valuation. Currently, the stock is priced at $9.71. Tangible book adjusted is $15.70. I'm going to ask myself some what ifs. So I'm scaling into the position now. How am I going to get out? When am I going to look at this and say, okay, I've made enough based on its valuation? Well, when it's trading at 1 times its tangible book, that would imply a $15.70 share price, obviously. If we were to get back to its historic mean, that would indicate an implied market price of $31.40, where it has certainly traded easily in the past. And the question is, okay, well, what I might start to do is take advantage of that 62% upside from simply reverting back to the market paying it for its actual book value, which seems to be an attractive opportunity for me, given that the company also yields about 10% in a dividend. So I get paid 10%, making a real return to simply wait for this reversion to the mean. And I would start to trim the position a tiny bit at that point, but over the long term, if I'm getting paid 10% to wait, assuming and provided that nothing happens, the management doesn't start to do anything crazy and all that sort of thing, if everything else remains the same, I'd be quite happy to ride it up towards that sort of $31.40, which would be a three-bagger, so 323% potential upside on offer. Here is a horrible looking sheet, I know, but on the last column is for 2022. And what I've done here is just taken a snapshot of the balance sheet in ratio format and put it in just to highlight a few things. So we're interested in, okay, we're trading at a steep discount to book, but is that book value likely to capitulate? We don't think so, because we can adjust for that held to maturity. What is the health of the bank overall on its balance sheet? Is it likely to incur a liquidity crunch? I don't think so, because it's already had a lot of deposits been withdrawn in fear, and now we've seen that slow. It makes up a very small percentage of its total assets. So non-performing loans to total loans and total assets, very, very low percentage. This is good. Definitely lower than 1. Gross loans to total deposits, not ideal. I prefer that to be around about 80, but I don't know if many banks would even do that these days. Tier 1 capital, 10%. Double digits is good. That's I believe that would be better than most of the banking sector at the moment. So seems to be okay as far as that goes. Then we're talking about, okay, we know that there's value in the net asset value, in the book value. We're going to have to wait, presumably, be patient until the market realizes that and bids back up the stock. Do we get paid to wait? Yes. How much? Let's take a look at it from an earnings and a dividend valuation perspective. So here's the payout ratio historically for this company. So they've paid out, as much as 85% of their earnings as a dividend over the years. And so we're currently around that sort of 30%. I reckon anywhere around 50% would be fairly standard for this type of company, this type of bank. So again, if we go back to the data and we pull out the history for the earnings and for the dividends, you'll notice here they've been able to grow their earnings at a CAGR, a compounded annual growth rate of nearly 7%, which is really not too bad for a bank. Then they've had 1 year of negative earnings here. That must be COVID, is it? Pretty close to being COVID. Yeah. And then if you're looking at the dividends have remained constant. So they do keep a fair amount of retained earnings, and they can pay that out as a dividend. And I'm going to use $1 a share as a dividend going forward. That seems to be sustainable, given that net income after tax of the company is around about 300 million as of this year, and then that would incur, in order for the company to pay out $1 in dividends, it works out to be around about a 30% or 33% payout ratio. So for every dollar profit, they're paying one of those dollars back to the investor as a dividend. Seems to be fairly sustainable. So if I use the dividend growth model or the earnings growth model, I'm going to simply take analysts' word for 2023 being $1.90 in earnings. If we take a look back, that's a steep haircut on what they earned the year before. Okay, so this, I believe, 2022, 2021, 2020, yes. And then their expectations for 2024 is that they're going to resume their growth rate. So if we take 2023's estimate of $1.90, Can they hit a 6% growth rate in their earnings? I think that's fairly conservative, considering that they were able to do 7 over the last 10 years, including one big negative year with COVID. Current dividend, we're going to use $1 to be fairly safe, and to say, can they grow that at 1% over the next 5 to 10 years? And I think that they can. If we were to look at getting a 14% rate of return, depending on what your inflation metric is, that would be 10% real return or return over current bond. It would be, again, pick your metric. It might be an 8% real return after inflation, depending on whether you use the official numbers or shadow stats. You get the idea. But if you're looking for a nominal rate of return of 14%, which is quite good, and you're expecting a PE of 8 at that terminal sale versus the 10-year mean of 14%, so we're basically half of what the market would normally pay in terms of a price to earnings ratio. In 10 years, you collect these dividends from these cash flows. Your sale price is expected to be $27, so less than the book value. So I think that's a pretty reasonably conservative estimate. And the sum of the reinvested dividends. Okay, so you'd receive twice your invested capital. So you're paying $970 up front. Over the next 10 years, you get $20 back in dividends alone, plus the sale of $27. So you'd be earning a total cash return of $47.44 for every $9.71 bought today at the current share price. So it seems to be doable, in my opinion, and it seems to represent good value, in my opinion. In order to get that 14% return, you'd have to buy it below $12.80. We've got nearly a 30% margin of safety on that number. So when we put all this together and we consider the fact that it's trading at a very steep value to the book, me personally, I think that that's compelling value. It gives me an opportunity to enter into the financial sector. We're very heavily invested in commodity space, as you guys will know. Nothing's changed from my thesis with the particularly energy. I think to be able to get this and create even more income in an inflation beneficiary, just in a different sector, is very attractive for me. So if we look at the technicals, last slide before the verdict here, if you look at these momentum indicators down the bottom, you'll see things got way oversold. The selling momentum has basically stopped. And if you look at the MACD, that would suggest we're starting to get more buying pressure, bidding up the price of the stock. So my particular verdict, I'm accumulating in the eToro portfolio. It's at a discount to its tangible book. Are we at a cyclical low? According to those metrics I used, we are. It's never traded, or at least over the last 10 years, it's never traded below half of its book value. So that appears to be getting pretty close to a cyclical low. There's definitely hidden value in there, and we get paid to wait via the dividends. So I'm aiming to make this about 3 to possibly 5% of the portfolio, and I'll be doing that in tranches. So I'll be steadily working my way in. And yeah, if you're interested in this style of investment, you can copy the portfolio. There'll be a link in the description. Please do like and subscribe to the channel, and leave your comments. It helps with the algorithm, and I enjoy reading them. And if you're interested in trading this at a faster pace and really juicing up the yields, gaining more income from this particular stock and finding a way that you can potentially buy it for cheaper using options, make sure that you at least subscribe for a free trial of the Options Mavericks or on the free list in the link below. Otherwise, take care, guys. Do your own due diligence. This is just my opinion, and I look forward to seeing you in another video shortly. Take care.